It took the worst bond market in modern history to create the only crash in 150 years where a diversified 60-40 felt worse for longer than an all-stock portfolio. Wild, right? But the story actually reproves why diversification matters, especially near retirement. I'll show you here. I'm Hunter Brockway with Boca Retirement Strategies. If you're 50 to 65 and wondering whether 60-40 broke in 2022 to 2024, this will calm the noise and give you a practical plan. What 150 years actually shows. Looking back at a century and a half, stocks had 19 bear markets, meaning a decline of 20% or more. Bonds had 3 bear markets. A 60-40 portfolio had 11 drawdowns big enough to call bears. In almost every decline, the 60-40 fell less and recovered faster than stocks alone. Some examples: the Great Depression, stocks lost about 79%. The 60-40 lost about 53%. Still terrible, but far less pain. In the early 70s, inflation, Vietnam, Watergate, stocks fell about 52%. The 60-40 fell about 39%. The lost decade in the 2000s, stocks fell about 54%, peak to trough, the 60-40 about 25%, and even poked back to break even mid-cycle. So why did 2020s feel so rough for the 60-40? Because we lived through a stock downturn overlapping the worst bond sell-off in generations. Stocks fell into a bear market in late 2021, early 2022, and recovered by September 2024. Bonds, already weak since 2020, kept sliding, delaying the 60-40's recovery until June 2025. Translation: the usual offset from bonds didn't show up when you needed it. That's why a classic 60-40 felt worse for longer this time. But even here, note this, the 60-40's depth was still under the depth of stocks alone or bonds alone. Diversification still reduced the damage, it just took longer to heal. During the thick of it, we tried calling the bond market to ask if they were done yet, but it kept going straight to voicemail. A helpful way to measure investor pain is depth times time. You can call this the pain index. A shallow drop that recovers fast hurts less than a deep, long hole. In the Great Depression, stockholders felt the 4x pain of the 60-40 holders. In the 2000s, stocks felt 7 to 8x the pain of the 60-40. In this cycle, the 60-40 had more pain than stocks only because bonds lagged recovery, a once in a 150-year setup. The big picture: one anomaly doesn't overturn 150 years of history. The reason we diversify is we don't know whether the next hit arrives from stocks or bonds or some other apocalypse du jour, when or where or how long it will last, nor where the top or the bottom is. What to do if you're 5 to 10 years out from retirement? Number 1, build a portfolio income war chest so your retirement income can survive any market downturn. So you're never forced to sell investments at a permanent loss. This is what you may have heard us call our buckets strategy. Number 2, shorten your bond risk where appropriate. Use shorter duration, higher quality core bonds for spending buckets. Number 3, diversify within bonds and stocks. Mix treasury, IG credit, maybe a sleeve of tips in equities. Avoid single stock type concentration. Number 4, sequence of returns defense. Use a guardrails plan. If markets drop early in retirement, trim withdrawals temporarily. Replenish your cash bucket after it rebounds. Number 5, tax and IRMA coordination. Map Roth conversions, where to pull from taxable traditional or Roth accounts, and keep an eye on Medicare threshold. The right sourcing can cut taxes and extend portfolio life. When markets do drop, take the opportunity to make smart money moves. Reframing the 60-40 for your next decade. A 60-40 is not a magic number, it's a principle: own, growth, and ballast. Maybe your number is 55-45 or 65-35 or 70-30. The point is to pair return drivers with shock absorbers and fund your cash runway to match your goals. If you did that in 22 to 25, you felt frustration, but you didn't have to take permanent losses. A friendly reality check: the last few years were a statistical oddball. That doesn't mean 60-40 is broken, it means the market reminded us to keep a real cash buffer, control bond duration, and stay diversified so you're not betting on which market crashes out next. If you want a guide to help you build your retirement income without running out of money, download our free Tax Smart Retirement Workbook using the link in the description below. It's built for 50 to 65-year-olds who want clarity before and after their retirement date. I'm Hunter Brockway with Boca Retirement Strategies. Enjoy your successful retirement with more money, less taxes, and less stress.
Before you go, if you're looking for a free Tax Smart Retirement plan tailored to your unique specific situation, you can head over to our website at bocaretirement.com. Enter your information in the pop-up, and we'll build you a plan tailored to your unique specific situations at no cost or obligation. If for some reason that pop-up doesn't show for you, if you click out of it, no worries. Just send us an email at contact@bocaretirement.com. Again, that's no cost, no obligation. We'll put together a simplified plan for you to help you take the next steps towards a successful, stress-free retirement with more money and fewer taxes. See you over there. Bye.